Hello and welcome to Invest Corners. I'm Karishma, your financial coach and a certified financial planner by profession. Today we will explore the financial planning pyramid, a step-by-step method to build wealth securely and sustainably. Just like a pyramid, financial planning must be built layer by layer, step by step, with a strong foundation supporting everything above it. Strong foundations only create lasting wealth. The financial pyramid shows what to do first and what comes later. It is a step by step guide to managing money wisely. Just like building a house, you can't put the roof before laying the foundation. At the base is protection, which consists of health insurance, life insurance, your emergency funds, and debt reduction. This layer safeguards you from financial shocks and emergencies. The second layer is savings and goal planning. This layer states setting aside money regularly for financial goals and investing the same for your goals like education, retirement, new home, and other life goals. The third layer is growth and diversification. It explains investing is only not important, investing with diversification into different assets like equity, debt, commodities, which beat inflation and growth wealth with minimum risk is very important. The fourth layer is speculation. This layer consists of high risk, high reward assets like crypto, forex, but only with surplus money you can go with this particular layer of your pyramid. At the top is wealth distribution, which consists of your will planning, estate planning, and succession. So, your wealth benefit should be passed to your family and future generations with minimum efforts. Now, why the structure is important? Because each layer protects the next. Skipping steps make your financial house shaky and risky. Let's start with Ria's story, a real life consequence. Let me tell you about Ria. She is 28, young, ambitious, earning 10 lakhs a year. Like most of us, she was excited about building wealth. She skipped the basics and went straight into stock investments, chasing quick returns, dreaming of financial freedom. Then a crisis happened. Her father had a serious accident. The surgery and months of treatment cost several lakhs. He had no health or disability insurance, and in that moment, all of Ria's carefully built savings were gone because her parents were dependent on her. When planning insurance, consider your dependent family members too, your spouse, children, and even aging parents if they rely on you financially. The emotional toll was even heavier for Ria. At a time when she needed peace of mind to take care of her father, she was also worrying about money, loans, and lost opportunities. If Ria had followed the financial pyramid, if she had started with a protection layer, health insurance would have covered the bills, her emergency fund would have cushioned the impact, and her investments would have remained intact, compounding for her future. This is the real cost of skipping protection. One unexpected event can erase years of hard work and set you back to zero. Now let's come to the first layer, that is a protection layer, the foundation. The very step in the financial pyramid is protection. Before thinking about investment, stock market or property, you must first build a safety net. This protection layer shields you and your family against financial shocks and emergencies. As emergencies are unpredictable, a medical crisis, a job loss, or even an accident can derail your finances overnight if you don't have safeguards in places. The protection layer includes 5 key elements. First is health insurance. It covers your hospital bills and prevents your savings from being wiped out by medical emergencies. In India, medical inflation is 14%, the highest in Asia. Without cover, one illness can set you back years. Life insurance, it ensures that if something happens to the breadwinner, the family can maintain their lifestyle, pay off debts, and meet financial obligations. Critical illness and disability insurance. Even if you survive a serious illness like cancer or heart attack, treatment cost and income loss can devastate your finances. This cover ensures you still have an income. Debt reduction loans can be a financial burden. If more than 30 to 35% of your income goes into EMIs, you lose flexibility to save and invest. Reducing debt ensures financial breathing room. Emergency fund. Ideally, 3-6 months of expenses kept in liquid assets. This act like instant cash during unexpected situation like job loss without touching long-term investment. In simple terms, the protection layer is your financial fortress. Without it, one emergency could collapse everything you have built. That's why the golden rule of financial planning is protection first, growth later. Why is protection urgent? Because healthcare costs are rising at an alarming pace, much faster than normal inflation. Medical inflation. India's medical inflation rate in 2021 was 14%, the highest in Asia compared to just 6% general inflation. This means medical costs double every 5 to 6 years, making healthcare more and more unaffordable. Future surgery cost. A heart bypass surgery costs rupees 3 to 5 lakhs today. In 10 years, the same procedure may cost 10 to 12 lakhs. Without insurance, family must dip into savings or take loans, destroying financial plans. Insurance claim reality. In financial year 23-24, Indian health insurers paid around 70,000 crore in claims. The average claim size was 38,000 crore, but critical illness claims often run into several lakhs. This proves medical emergencies are not rare events, they are happening every day across the country. The urgency. One unexpected medical bill can wipe out years of savings, force families into debt, delay child education or retirement plans, or other your goal plans. That's why protection cannot wait. Buying health and life insurance early is the only way to safeguard your financial future. There are certain protection rules that need to be followed for the protection layer. First, life insurance. Your family depends on your income. Without adequate cover, their lifestyle and future goals collapse if something happens to you. So the rule must be life insurance cover should be 10 to 12 times of your annual income. For example, if you are earning 10 lakhs annually, your cover should be 1 to 1.2 crore. This ensures your family can survive for years debt free. Second, health insurance. As we know, the medical cost in India is rising every day. So the minimum rule should be 5 to 10 lakhs family floater policy for all your dependents. Without health insurance, one medical emergency can wipe out years of savings in a single blow. You can even buy top up of around 15 lakh rupees on your base policy of 10 lakhs rupees. There is third one is critical illness cover. As we know, in the critical illness in India is rising every day. People are getting detected with heart attacks, cancers or strokes, which can cost you around 15 to 25 lakhs in treatment. Even worse, you might lose income during recovery as it takes 3 to 6 months of bed rest. So the rule is you need to have around 50 lakh rupees critical illness cover. This protects both treatment expenses and income replacement for your family. Fourth is emergency fund. Job loss, accidents, or sudden family needs happen without warning. So we need to keep minimum 4 to 6 months of expenses in liquid form, which can be kept in liquid mutual funds or in your savings account. This avoids dipping into investments or loan during crisis. Last one is debt management. High EMIs can choke your financial freedom. So the rule is the EMIs need to be kept under 30 to 35% of your income. Too much debt makes you financially fragile, especially during emergencies. Now we will come to the second layer of financial pyramid, that is savings and goal planning. Once you have built your protection foundation, the next step is saving and goal planning. This stage is not just about putting money aside, it's about saving and investing with a purpose. Why goal planning matters? Every financial goals, whether it's your child education or buying a home or retirement, has a specific timeline and cost. If you don't plan in advance, you end up borrowing at high interest or compromising on your dreams. Investments must be linked to your goals. For short-term goals, you need to invest into mutual funds, liquid mutual funds, and FDs. For medium-term goals, you need to invest in debt funds, balance funds, and recurring deposit. For long-term goals, you need to invest in equity mutual funds, NPS, PPF, etc. For example, if you are saving for your child education for 15, which is 15 years away, parking money in a saving account won't help. Inflation will eat it away because the returns are less than the inflation. But a SIP in equity mutual funds can compound wealth and beat inflation. On the other hand, if you are investing for a family trip in 2 years, equities are too risky, a short-term FD or liquid fund is safer. As you can see, here's what happens when families don't save systematically. Education loans. As of March 24, India has 79,000 crore in education loans outstanding. Every year, 7.5 to 8 lakh students borrow to fund studies, often because parents haven't planned early for education. This creates a debt cycle that starts even before a career begins. Second, household saving collapse. Net household savings in India fell to a 47-year low in financial year 23. That means people are spending more, saving less, and relying on debt. Parents are forced to borrow heavily for their children's education. Senior citizens take personal loan or mortgage property just to survive post-retirement. Many retirees are even pledging gold simply to meet their basic expenses. Without disciplined savings, families get trapped in a cycle of debt that spans generations. Instead of passing down wealth, debt is passed down. Now let's look at the tale of two families, two real world approaches to money and the long term consequences. Family A, the savers, Raj and Meera. They started saving 10,000 per month early and stayed consistent. Over 10 to 15 years, their disciplined SIPs compounded into enough funds for their child education around 20 lakhs and a comfortable retirement of around 3.5 crore. No education, no late stage financial stress. Family B, the borrowers Suresh and Anjali. They delayed saving and relied on credit when their child needed funds for higher studies. They took a loan of 25 lakh education loan which cost them 30,000 a month in EMIs for years. EMI ate into their retirement savings and reduced their financial corpus significantly. The difference wasn't income or luck, it was timing and discipline. Key points to highlight: early consistent saving compound dramatically thanks to time and returns. Borrowing for planned expenses increases total cost and reduces the ability to save for retirement. EMIs crowd out savings and increase financial stress. Now that protection is in place, the second layer of the financial pyramid is savings, investments, and goal planning. To make this effective, there are 5 golden rules everyone should follow. Monthly savings target. Save at least 20 to 30% of your income every month. Think of it as paying yourself first. This discipline is the backbone of all future financial goals. For example, on a salary of 1 lakh, you must save and invest 20 to 30,000 monthly before lifestyle spending. Retirement corpus target. Your retirement fund should be 20 to 25 times of your annual expenses. This ensures you maintain your lifestyle without depending on anyone in your retirement period. Home loan management. Don't let home ownership cripple your financial flexibility. Keep EMIs within 20 to 30% of your income so that you still have space to save interest and invest the same for other goals. Otherwise, the house will become a financial trap instead of an asset. Goal-based approach. Saving without goals are directionless. Link every goal to specific investments, SIPs for education, retirement accounts for the future, recurring deposits for travel. Even you tie your money to a dream, it keeps you motivated and disciplined. Together, these rules make savings not just a habit but a structured financial strategy that ensures you achieve your life goals debt-free. Savings become powerful only when they are disciplined, goal-driven, and structured. We have now covered the foundation, protection, and savings. These are the non-negotiables that keep you safe and disciplined. In the next video, we will dive into exciting layers, growth, speculation, and wealth distribution. That's where wealth multiplies and legacies are created. But remember, without a strong base, those layers can collapse. So till we meet again, take time to work out on your financial pyramid, review your protection, calculate your savings, and strengthen your foundation.